This just happened, and if you blinked, you missed one of the most violent reversals in modern metals trading. Silver was down near $78, and within hours it ripped more than 12% to roughly $90 an ounce. Today, February 3rd, 2026. That's a $40+ round trip from the highs near 120 in a matter of sessions. And here's the thesis you need to hear right now. This wasn't a normal sell-off, and the rebound isn't random. The real trigger isn't what most headlines are saying. Stay with me, because I'm going to show you how to recognize this pattern the next time it shows up, not after it's already gone. If you're holding silver, if you're watching metals, if you're stacking physical, your job right now is to understand what just broke and why the bounce matters more than the drop. Before I explain what caused this, let me teach you something most people never learn about leverage markets. Price doesn't always move because supply and demand changed. Sometimes price moves because balance sheets break. Think of it like a crowded theater with one narrow exit. Nothing's wrong with the building. The air's fine. The seats are fine. But if someone yells fire, people don't calmly reassess the situation. They rush, they push, they trample each other to get out. In markets, that fire is margin. When volatility spikes and exchanges hike requirements, traders aren't deciding to sell because they think silver's fundamentally broken. They're being forced to sell because their broker just called and said, "Post more cash," or "We're closing your position." And when that happens, price discovery temporarily stops being about fundamentals and starts being about survival. It's not, "What's silver worth?" It's, "How fast can I get liquid?" Now here's what you need to understand about margin mechanics. When you trade futures or levered products, you're borrowing most of the position value. Let's say you control $100,000 of silver exposure with only $10,000 of your own money. That's 10-to-1 leverage. Sounds great when price moves your way. You make 10 times the gain. But when volatility jumps, the exchange doesn't care about your thesis. They care about counterparty risk. So they raise the margin requirement from 10% to 15% overnight. Now you need $15,000 to hold that same position. If you don't have it, your position gets liquidated, automatically, no debate. And when thousands of traders hit that threshold at the same time, you get what's called a cascade. One wave of forced selling pushes price lower, which triggers the next wave, which triggers the next wave. It feeds on itself. That's not a market repricing fundamentals. That's a mechanical liquidation event. And if this is making sense, drop a comment below and let me know where you're watching from, because understanding this concept is how you separate signal from noise in volatile markets. Now here's what's actually happening with silver. Silver had been trading heavy leverage, especially in paper markets tied to futures and swaps. As price dipped from 120, margin requirements quietly rose. Funds had to post more collateral or liquidate. Then price slipped again, more margin calls. Then the cascade hit. In a single session, silver flushed to 78. That's not orderly selling. That's not traders calmly updating their models and deciding silver should be worth $40 less. That's a liquidation event. You can see it in the volume spikes. You can see it in the intraday range. You can see it in the speed of the move. Markets don't normally lose 15% in hours unless something structural is breaking. And here's what's wild about this. Right near the lows, reports surfaced that JPMorgan Chase had closed short positions, right as systems at the London Metal Exchange and HSBC experienced temporary outages. Now, coincidence? Maybe. Stress signal? Absolutely. Because when infrastructure hiccups appear at the same moment forced selling peaks, that tells you the paper market is under strain. It tells you the plumbing is creaking. I'm not saying anyone did anything nefarious. I'm saying the system was stretched. When you've got massive position unwinding happening at the exact time trading systems go offline, even briefly, that's a sign that liquidity was thin and stress was high. But here's the part that should make you pay attention. While all of this forced selling was happening, something else was going on in the background. Reports started coming out, quietly at first, that strategic buyers were stepping in. Not retail panic buyers, not momentum chasers. Strategic, policy-driven buyers. And that's the layer most people are missing right now. Let me show you what very few people are talking about. While traders were being forced out of levered positions, governments were stepping in to accumulate physical. The U.S. just unveiled a $12 billion strategic critical minerals stockpile, quietly branded Project Vault. This isn't some think tank proposal. This is appropriated budget. At the same time, Washington is hosting a critical minerals ministerial with more than 50 nations. The EU is offering partnership deals. China's been stockpiling for months. That's not noise. That's policy. And here's the difference. Policy-driven demand doesn't panic sell. Policy accumulates on weakness. Policy has a mandate, not a margin call. So, when you combine forced liquidation on one side and strategic accumulation on the other, you get exactly what we just saw. Violent volatility followed by a structural bid. That's why price snapped back so fast. The bounce wasn't relief. It wasn't short covering, at least not primarily. It was a vacuum filling. When all the forced sellers are done and the only participants left are buyers with conviction and no leverage, price finds a floor fast. And then it rips. Because there's no supply left at those levels. Everyone who had to sell already sold. Now you've got strategic demand bidding against thin supply. That's the setup. Zoom out, and you've seen this movie before. This is the exact same playbook oil ran in the 1970s. I want to walk you through this because the pattern repeats. And if you understand it, you'll recognize it the next time it shows up in any commodity. In the early 1970s, oil was considered a cyclical industrial input. Supply was abundant. OPEC wasn't coordinated. Price was stable around $3 a barrel. Then in 1973, the Yom Kippur War hit. OPEC imposed an embargo. Supply got tight. But here's what most people forget. The initial spike was followed by massive volatility. Price dropped. People thought it was over. Then the strategic stockpiling began. The U.S. created the Strategic Petroleum Reserve in 1975. Other nations followed. Oil went from cyclical input to strategic asset. And what happened next? Price didn't go straight up. It chopped. It scared people out. But over the next decade, the floor kept rising. By 1980, oil was trading near $40. That's more than a 10x move from the early 70s baseline. Not because of a straight line rally, because the fundamental role of the commodity changed. Same pattern with gold after 2008. Gold had been in a bear market for 20 years. Central banks were net sellers. They saw it as a relic. Then the financial crisis hit. Lehman collapsed, trust in the system fractured, and central banks flipped. They went from net sellers to net buyers. That policy shift happened quietly at first, but once it took hold, gold's floor changed. It wasn't trading at 300 anymore. It wasn't even trading at 600. The new range was higher. Gold chopped between 1,000 and 2,000 for years, scaring out weak hands with every dip. But the strategic bid kept the floor elevated. Every time a commodity transitions from cyclical input to strategic asset, the market reprices its role, not straight up, not smoothly, but persistently. The volatility scares people out early, and the policy tailwind carries price higher over time. And that's exactly what we're seeing with silver right now. For decades, silver was industrial. It was a byproduct of other mining. It was abundant enough that nobody worried about supply. But now it's critical for solar panels, for EV components, for defense systems, for electronics that can't be substituted. And governments are waking up to the fact that they don't control enough of it. That's a reclassification in progress. Now, before we go further, I want to acknowledge something. Not everyone watching this is convinced, and that's fair. So, let me be skeptical for a moment, because I want you to hear independent thinking, not just hype. Could this be manipulation? Maybe. Could the rally fade? Of course. Could silver retest lower levels like 70 or 75? Absolutely, especially if leverage rebuilds too quickly and we get another flush. Could JPMorgan have timed to trade perfectly and made a fortune while retail got crushed? It's possible. I don't know their book. Nobody outside that firm does. Here's the thing, though. It doesn't actually matter whether some bank gamed the move. It doesn't matter whether this was orchestrated or organic. The mechanics are what matter. Focus on what you can control: price action, volume, policy signals, how markets react to stress. Whether a bank timed to trade perfectly matters less than the fact that forced selling ended and buyers showed up immediately. You don't need a conspiracy theory to make money or manage risk. You need to read the map. And the map right now is showing forced liquidation, followed by strategic accumulation. That's observable. That's actionable. That's enough. Could this whole thing be hype and silver goes back to $50? Sure. Markets can do anything. But if that happens, it'll be because the fundamental thesis changed. Right now, the fundamental thesis hasn't changed. Industrial demand is growing. Strategic stockpiling is policy. Supply is constrained. Those are facts. The flush we just saw was mechanical, not fundamental. And that distinction is everything. There are probably 3 types of people watching this right now. Let me speak to each of you directly, because your situation is different and your next move should be different. If you're already long silver and you felt sick during that flush, let me say this. Your reaction was normal. Watching a position drop 15% in hours is brutal. It doesn't matter how convicted you are. It hurts. But here's what you need to understand. Volatility is not the same as invalidation. The thesis didn't break. The leverage broke. Your job now is discipline. Don't confuse a margin cascade with a fundamental collapse. Watch whether 85 to 90 holds as support. If it does, that's information. That tells you the forced sellers are done and the strategic bid is real. If price breaks below 80 and keeps going, then reassess. But right now, you're in the window where weak hands are shaken out and strong hands get tested. If you believed in the setup at 100 and nothing fundamental changed, then 78 was a gift if you had dry powder. If you didn't, then hold and wait for confirmation that support is real. If you're on the sidelines thinking you missed it, breathe. You didn't miss clarity, you gained it. The worst thing you can do right now is chase out of FOMO. Let price prove itself. Watch for a reclaim of 95 to 100 because that's where Shanghai parity comes back into play. That's where physical demand asserts itself against paper markets. Confirmation beats FOMO every time. If silver gets back above 100 and holds, you'll have more conviction entering than you would have had at 120 chasing momentum. And if it doesn't, you saved yourself from catching a falling knife. Patience right now is an edge. Use it. And if you're a skeptic who thinks this is all hype, I get it. I respect that. For you, the takeaway isn't to buy silver. It's to recognize the setup. Forced liquidation plus strategic policy equals asymmetric outcomes. That principle applies everywhere. It applied to oil in the 70s. It applied to gold in 2009. It applied to lithium in 2021. It'll apply to the next strategic commodity that governments decide they need to control. Study the pattern, because the next time you see forced selling hit a commodity that's transitioning to strategic status, you'll know what's probably coming next. So, here's what I want you to answer in the comments. Where are you on this? Are you holding through the volatility? Are you waiting for confirmation? Or are you sitting this one out entirely? I want to know what your plan is because that clarity matters more than the price action. Now, let me tell you where I stand. I'm not euphoric and I'm not bearish. I'm observant. I've seen this pattern enough times to know that the real money isn't made by guessing tops and bottoms. It's made by understanding the structural shift and positioning accordingly. So here's what I'm personally watching. First, I'm watching whether 85 to 90 acts as real support, not just an intraday bounce. If silver spends the next few sessions consolidating in that range without breaking lower, that tells me the forced selling is done and a new base is forming. If it breaks below 80 on heavy volume, that tells me there's more liquidation to come and I need to reassess. Second, I'm watching a reclaim of 95 to 100. That's not an arbitrary level. That's where global physical demand starts to assert itself again. That's where Shanghai premiums come back into play. If silver can get back above 100 and hold it, that tells me the paper market lost and the physical market won. That's a big deal. Third, I'm watching policy headlines, not tweets, not rumors, but actual budget allocations and international agreements. Because stockpiles change floors. If the US follows through on Project Vault and other nations join, that's a structural bid that doesn't go away when sentiment shifts. That's the kind of demand that supports higher price ranges long term. Based on my analysis, this event was mechanical, not emotional. The fundamentals didn't collapse. They're being reclassified. Silver is transitioning from industrial input to strategic asset. And that transition is messy. It's volatile. It shakes people out. But if history rhymes, and I think it does, the people who understand that early don't panic. They prepare. They watch. They wait for confirmation. And they act when the map is clear. If history rhymes and silver reclaims 100 and holds, the move that follows could be significant. I'm not making predictions. I'm reading probabilities. And the probability is that a commodity transitioning to strategic status doesn't revert to old price ranges. It finds a new floor. Whether that floor is 90 or 100 or 120, time will tell. but the direction is more likely up than down over the medium term, assuming the policy tailwind stays intact. Now, let me be clear, I'm not a financial advisor. This is not financial advice. I'm a guy reading markets and sharing my analysis. You need to do your own research. You need to understand your own risk tolerance. You need to make your own decisions. But if you made it this far, you're someone who values depth over hype. You're someone who wants to understand the why, not just the what. That mentality will serve you well, not just in silver, not just in commodities, but in every market you ever trade. If you found value in this breakdown, do me a favor. Share it with someone who's trying to make sense of what just happened. Subscribe if you want more analysis like this. And stay ahead of the noise, because the people who win in these markets aren't the ones who react fastest. They're the ones who understand the pattern and position accordingly, think critically, verify data, make your own decisions. Stay sharp out there.